As a stock trader, you can be 4 different things. You can be a bull having an optimistic view on the market. You can be a bear having a pessimistic view on the market. You can be a pig holding positions long enough to watch all of your profits dissolve. Or you could be a part of the Theta Gang. Now before this week, I've been a bull, I've been a bear, I most definitely have been a pig, but I have never been a part of the Theta Gang. Now you've probably heard the phrase before, bulls make money, bears make money, and pigs get slaughtered. Now this can be rephrased as bulls make money, bears make money, Theta Gang makes money, and pigs will always get slaughtered. So in today's video, guys, we're gonna go over 2 of the strategies that the Theta Gang uses to profit in the market. That will be put credit spreads and call credit spreads. And then I'll show you guys the trades that I made using those strategies. Now, if there's one thing alike between bears, bulls, pigs, and Theta Gang members, and that is that they all smash the like button on this video. Now, after watching that intro, you're probably thinking, what is Theta and why is it part of a gang? Theta is the rate at which an option contract decays over time. That's one of the Greeks that you have to consider when trading options. And the gang part just comes from it being a group of option traders that uses this strategy. So simply put, Theta Gang is a group of option traders that will capitalize off of theta, which is the rate at which those option contracts that they sell expire over time. Now, instead of betting if the stock will go up or if it will go down, these traders are betting that the stock will expire out of the money and worthless by the time of expiration. Now, if you've been buying puts and you've been buying calls and you've been losing money, there is someone else on the other side of that trade that sold you that contract, and that is most likely a Theta Gang member. Now, I know for some beginning option traders, as well as for some option traders that are just accustomed to buying puts and buying calls, this is a little bit more difficult of a concept to comprehend and to grasp onto from me just talking to you about it. So that's why I want to jump into the charts. I want to show you exactly how to place these trades, how to profit from these trades, and sort of the mindset that you should have while you're in one of these trades. After that, we'll go over the trades that I made using these strategies. All right, guys, so I got the charts built up here. Let's go ahead and dive right into it. First, let's go over a put credit spread. So put meaning that we're going to be on the right side of the options chain here. We're looking at an April 15th expiration for the SPY. So I have the SPY pulled up here. Before we go through the option and the strategy, let's go ahead and build ourselves a scenario so that we sort of think through this logically. So let's say we think that this support and resistance and then this support here will turn into some further support as we move forward and as we go to April 15th, which is the expiration. So we want to say that the stock is going to stay above 270. So let me go ahead and draw that 270 there. I'll make it exactly 270. And I'll make this a green line because basically that's saying that we want the stock to stay above 270 and we'll make money as long as it stays above there. So what our first leg of this strategy is we're going to be selling a 270 put. Now the reason we do this is because think about it, if you were to buy a 270 put, where do you want the stock to go? You want it to stay below 270. If we were to sell a 270 put, we want the stock to stay above 270, right? So when we do that first leg of the strategy, we go here, this is the options chain, this is the bid of the ask price, this is the strike prices here, and this is the expiration. So we see right here 2.44, that's $2.44 for that contract. If we were to sell it, that's the premium that we would receive. So if we press that there, we can see that the bid is 244. So for this example, let's bring it down to that. And obviously it defaults to 10 contracts. So we want to go ahead and bring that down to 1. So how much will we receive into our account for selling this put? We'll receive $244, right? So the reason why there's another leg to this is because just selling a put, which is in this situation is selling a naked put, is an extremely risky strategy. So if we go to the snapshot analysis, we can see the risk and reward ratios here. So max profit on just selling this put, $244. Now the reason for that is no matter where this stock goes, it could go to 1,000. All you're going to be getting is the premium that you got originally. So you'll receive $244. Now the reason you'll keep that is because this contract, a 270 put, will expire worthless if the stock goes to 1,000. It'll expire worthless, it'll go to 0, and you'll keep that premium. So there's your max gain on this trade here. Now what's your max loss? $26,756. Now why is that? So this contract obligates you to buy 100 shares of SPY at 270, no matter where the stock price is. So if the stock goes down, if it goes down to zero, let's say, it goes all the way down, it goes in the money, this 270 put, and it goes to zero. That's your max loss. So how do we calculate that? You're obligated to buy 100 shares of SPY at 270, right? $27,000. You always keep the premium, no matter what. So you subtract the 244 that you received in the beginning, $26,756 if the SPY goes to zero. Now, the likelihood of that happening, probability of maximum loss, 0%, and I would agree with that. There is 0% chance that the SPY goes to zero by April 15th. The probability of maximum profit, 73, about 74%. So as you can see, the risk reward in this strategy is terrible, but the probability of this hitting is high, and the max loss is enormous. Now, personally for me, that max loss is too big to weather, and that's why there is another leg to a put credit spread. So the second part of this strategy is buying a put as insurance. So if we go ahead and say we think that the stock will, let's say we think it'll stay above 270, but we want to limit our downside and have the right to buy it at 268. So then that means we would then buy a put at 268. So right here, you're buying that put, $2.08 for that put to buy it. Now, what does that do for us? This gives us a spread of prices, right? So if we were to put a line here at 268, let me just move that a little bit. So 268, and we're going to make that red. Because if the stock goes below 268, we will hit our max loss. And if it goes above 270, it'll be our max win. Now, what is going on as we do this? So we're receiving $2.44 as premium. So let's go ahead and move this down to the bid on both, just for this example. So we would be receiving $2.44 to sell, and we're going to be buying, so giving out $2.08 to buy. Now, the difference between this is the spread, and that's what we're going to be receiving. So that's $36. So we move this one. We'll be receiving $36 to make the spread. Now, what is this buying doing for us? So as you guys remember before, we had a max loss all the way down to zero. Now we have a max loss up to 268. So if the stock falls past 270 and goes below 268, we are now capping our losses here at 268. No longer do we need to worry about any price below this, because we have the obligation to, or we have the right to buy at 268, which will then pay this obligation to buy at 270. So now we are capped at a loss below 268. So if we go to the snapshot analysis, we can see that this is a much more conservative strategy and something that I would be more willing to take, right? So our max profit, again, is that $36 in premium, which is the spread between these two. And then the max loss is $164. Now, how do we get to that $164? So your max loss is calculated by taking the difference between the strike prices, so 270, 268, so that's your difference here, right? So that's $2 per contract. So if we calculate that, we have $2 per contract. We have 100 shares, because that's one contract. And then, as you guys remember, you always keep the premium no matter what. So we're subtracting 36. So our max loss here is $164. No matter where this stock goes, it could go to 230 by April 15th, and we would still only lose $164. Now, I want to make a line here on April 15th, just because it, sort of gives us an idea of when we're going to be going until. So that is exactly where April 15th, let's make that at 1600. So that would be 4 o'clock on that day. So 1600 on April 15th. So as you can see, as we sort of graph this out, we would want the stock to stay above 270 here by this red line. Now, if it's below 270 by this red line, we'll be hitting our max loss, $164. The probability, as it says right here, 73% that it'll stay above 270, and it's 21% that it'll be below 270 or 268, right? So as you guys can see, this is a strategy that sort of uses that theta, that time decay of saying, okay, this stock will stay flat or it will go up and it will slowly decay over time. And I want both of these options to expire worthless. What we want in this strategy, our main goal is that both of these expire worthless and we keep that premium. All right, guys, so I hope that gives you a little bit of a better idea of how that put credit spread works, how to place that trade, sort of what to think through while you're in that trade. Now I want to go ahead and go over the call credit spread. So now that we're on the call side, we're going to be on the left side of the options chain. The first part of this strategy is still to sell a call. Now the first part on this side was to sell the put. Now we're going to be selling a call. So what do we have to think through when we're doing this strategy? When you're selling a call, you want a stock to stay below that strike price that you choose, right? Because when you're buying a call, you want the stock to go above that strike price. So let's go ahead and think of a scenario here first. So let's say that we think that this support here and then this resistance here will turn into future resistance by April 15th. So we think that the stock will stay below 290. So let's go ahead and draw that line. So 290, it's about 290.03, so we'll go there, 290, and we'll make this green. So as long as the stock stays below 290, we will be profitable. So what do we do? The first thing we're going to do is we are going to press the sell here on 290, on the bid price, right? So 290, we're going to be selling that. So if we go to 1, we'll be receiving $94 if we just were to sell this. Now again, the loss, the potential loss on this is very, very high, and in this case it's actually infinite, right? Now why is the max loss infinite? Because there is no cap on how high this SPY can go. There's no zero, there's no cap. So in this situation, your max loss is infinite when you're selling a call, and that is not something that I want to play around with, and that's where you bring this spread, this call credit spread, into play. So where do we want to cap our losses? Now that really depends on where you think the stock can go and also how much premium you want to receive for doing this. So what you can do is you can cap your loss at 291, right? You can just buy a 291 call. You could create your line here at 291 and you'd cap your losses there. Now what you'd see is that you receive much less of a premium, right? Because you're only, in this case, if you were to buy this 291 call, you are now only receiving 12 cents per contract if you were to do it on the bid, right? In this case, we're just going to go to the bid to make it nice and easy to see, what these prices are showing. So you're going to be selling on the bid and buying on the ask. So you'd be receiving $12 if you go to 1. $12. Now that's, a very small amount. And if you go to your snapshot analysis, you have an 82% chance of winning. And your max loss is $88, right? Because it's $1 spread times 100, that's $100, minus what you received, so that's $88. So this is a, more of a conservative trade, right? Your probability is pretty high. You get 82% that you'll get that $12, that both of these contracts will expire out of the money, meaning that this stock will stay below 290, and your max risk is only $88. Now what you can do is you can widen that spread, and what that will do is it will increase your risk, but it will also increase your reward. So you can do this on both sides. You can do that on the call and the put side. So if we were to sell a 290 and then we were to buy, let's say, a 295, so in this case we are now, let's draw this out. So let's go to 295 here. So 295 right about here. So let's make that red. So if the stock was to go above 295, we would hit our max loss. And if it was below 290, we would be our max gain. So what is our risk reward now? So we're gonna get $58 now for this trade, because the spread between them is 58. Now if we go to the bid like we were before, that's 55. So 92 minus 37 is 55. If you go to snapshot analysis, we can see that now, yes, our max loss has gone up because we've increased the spread, right? So now our spread is $5. So we do 5 times 100, that's 500, minus the 55 that we got. So we're now at 445 as a max loss, where our max gain has increased with that max loss increase. So you can see the probability is still similar, 82% to a 9% max loss. So our max loss probability has decreased. Now why is that? Because we've increased the spread, and the only way we get to our max loss is if the stock is above 295. So it's a little bit less likely that the stock will move past 295, whereas before it was only 291. So what we can see is if we were to do a 291 and we go to our snapshot, we can see that it's now 15%, right? Let's change this to 1 so that we make sure it's apples to apples. So now it's 15%, because it's more likely that if the SPY breaks 290, it may go past 291. So what you guys can see, similar concept, you're creating those spreads, you're betting here on a call credit spread that a stock will stay below a certain price at a certain time. And on the put credit spread, you think that the stock will stay above a certain price at the expiration. All right, guys, so we went over the call credit spreads, the put credit spreads. Hopefully that gives you a little bit more insight on how it works, what to think while you're in those trades, why you would enter those trades. Now I want to show you the two examples that I had trading put credit spreads and call credit spreads. So jumping into it here, the first trade that I had was on April 6th. So that was, I bought a 250, or sold a 253 put, and I bought the 251 put. So you can see that I received 27 cents or $27 because I bought one, and I paid $14 when I bought that put. So net, it was about $13 in premium. So very small amount. Now, the reason it was so small is because once I graphed these out, you can see how unlikely it was that the SPY would fall below 253. So at 950 I bought these, which is right around here, and the SPY was trading at 259. Now this stock would have had to fall down to here, past 253 and down past 251 for me to hit any kind of max loss by the end of the day. So that's a pretty big move. If we calculate that move, I can see the percentage. So from when I bought it, which is around here, to let's say down to my max loss, that was just about 3.5%, right? So the SPY would have had to fall 3.5% on the same day for me to hit my max loss. Now I was willing to take that risk, and I was able to lock in these profits, right? So as you can see, these both expired out of the money, option expiration out of the money, and I kept that premium because at the end of the day, the SPY actually continued higher and closed around 264. Now the next day, I did a call credit spread. So on the 7th, you can see that I sold a 280 call and I bought a 282 call. So around the same time, it was right around 9:55, 10 o'clock, I saw that the SPY had double topped here and really started to fall. So what I did at this point was I sold the 280 and I bought the 282. So if we go to 280, right around here, and I bought the 282, so right around here. So SPY after this fall here would have had to spike past 280 and past 282 for me to lose on this contract. Now these were expiring the next day, so if I pull that up, you can see that they are expiring on the 8th. So I did hold these up until the 8th, and as you can see, SPY ended up closing at 273, and both these options expired out of the money, right? Because it would have had to go past 282 for these to expire, both of them to expire in the money. Now, as you can see, I collected just about $30 for these. I think it was about $33 for this premium. So I was able to keep that premium. So I made $33 on the call credit spread and $13 on the put credit spread. So as you can tell, pretty small amounts there, but the probability of me winning these trades were very, very high. So I think this is a pretty good, consistent strategy to make small wins and to take bets that you are, more likely to win in the long term. All right, guys, so that's going to wrap up today's video on call and put credit spreads. I hope that you guys learned a little bit more about the strategy and how to implement them. If you have any other questions, add me on StockTwits. I'll put my profile right here. Ask me any questions you may have, and if you don't have StockTwits, go ahead and add me on Instagram. The link is down in the description below. If you guys enjoyed the video, if you took something away from it, make sure to smash that like button, subscribe to the channel, and I hope to see you in the next one. Peace.